The information given in any of our content under the name Cell NJ or Cell New Jersey should not be taken as financial advice. Any and all information should be used for informational purposes only. Please consult a tax or financial professional before making any decisions. Thank you and enjoy the video.
Welcome to Cell NJ, where we make real estate and finance easy. Today we are going to discuss the Charitable Remainder Trust and how this incredible strategy can save you on taxes while providing passive income for years to come. A Charitable Remainder Trust has three components to it: a charity, a trustee and a grantor. The charity or charities are set up to be the final beneficiary for the remaining balance within the trust. When the trust is initially set up, it's based on a single or sometimes multiple lives. For example, John sets up a trust and has donated assets worth $100,000. Once John passes away, whatever balance remains in the trust is given to the charity or charities listed. The second component is the trustee. The trustee controls the trust, how it's invested, payouts, taxes, etc. Finally, we have the grantor. This is the person donating the assets and the one that will receive the annual cash payouts for a period of time as well as a tax deduction from the initial donation. Let's look at a real-world example and see how we can benefit from this super powerful tax strategy. Don't forget to hit the subscribe button and turn on notifications so you'll know when we post more content on blockchain, cryptocurrency, real estate and finance. Now back to the video. Let's put all the components together, plug in some numbers and see how this tax strategy will work wonders for any investor. We'll use cryptocurrency for this example since the market is booming and getting ready to possibly hit another cycle high soon. We have investor John looking to cash out on $100,000 worth of Bitcoin and Litecoin. John also lives in New Jersey. Now let's discuss the tax breakdown if the assets were to be liquidated and retained. Federal long-term capital gains tax is 15% on his $100,000. The state of New Jersey will deduct an additional 10.75%, and the Obamacare capital gains tax is another 3.8%. These all total up to roughly 30% or $30,000 on your $100,000 crypto liquidation, leaving John with about $70,000 in cash. Now for the fun part. Let's take that same $100,000 worth of crypto assets, donate them to a charitable remainder trust and then liquidate them. By doing this we've just created two major benefits. The initial benefit is a tax deduction. The second benefit, which is the major one, comes in the form of annual distributions. Whenever you donate anything, whether it be a car, boat, property, or cryptocurrency, there's always a tax deduction. The same goes for this situation. Now, it's not going to be 100% deductible, there's some calculations that need to be done in order to figure out the actual tax write-off, but for this example, let's say it's $10,000. This deduction must be used within 5 years. Let's review the second benefit from creating the trust, and that's the annual distributions. For a max period of 20 years or for your entire life, you will become an annual beneficiary that receives annuity payments. These payments are based on a yearly percentage of the trust balance. Let's get back to John and clear up any confusion. John has donated $100,000 worth of Bitcoin and Litecoin to XYZ Charitable Remainder Trust. He has received a tax write-off of $10,000 and becomes the annual beneficiary. John, as the trustee, also liquidates the assets into a cash value of $100,000. The trust was set up to pay out for his entire life at a yearly rate of 10% for as long as he lives. Year 1, his payout will be $10,000, 10% of $100,000, the second year will be 10% of the remaining $90,000 and so on. However, these numbers are based on no annual return of the trust. Remember, John is now the trustee and in control of how the trust is invested and does so tax-free. Maybe John is a day trader and decides to use the trust as a tax-free trading account. Maybe John is into real estate and purchases a property to flip. Once the donation has been made to the trust, John is free to invest the trust how he so chooses. John is a big believer in cryptocurrency. After creating the trust, John leaves his Bitcoin and Litecoin inside the trust and now makes a modest 15% annual gain. Now in year 9, John has compiled payments of over $110,000. This is 10% more than his initial donation. By doing this, he's broken up his lump sum capital gains down into smaller, more tax-friendly payments. Instead of paying 30% on his long-term capital gains, he now pays around 14% on his annual trust distributions, creating a tax savings of around 50%. John can now collect yearly passive income in a low tax bracket for the remainder of his life, and once he finally passes away, John's hard work and proper investment strategies will pay dividends to the charity or charities of his choice. I hope you've enjoyed this video on charitable remainder trusts. Be on the lookout for additional videos showing how the trust can become even more beneficial using different strategies. That's it for this video. Don't forget to hit the subscribe button and click the notification bell. We appreciate you stopping by, and we'll see you on the next one.